So today we decided to lower interest rates from 25 basis points by 25 basis points to 0. And the reason for this decision is because inflationary pressure is lower in Switzerland, also inflation is lower, and this led us to this decision.
And of course, Mr. Schlegel, we saw this deflationary print in the month of May, negative 0.1%. Is that just 1 month? And are you worried about that 1 month sprint, or do you think that's the start of more entrenched disinflation or deflation even?
No, just negative inflation, current negative inflation for us is not a reason to lower interest rates. For us, important is the medium term and is the inflation in the medium term. Our goal is to achieve price stability, i.e. inflation between 0 and 2 in the medium term. So like one print or several prints that are negative in the short term are not really relevant for us.
Mr. Schlegel, the major question everyone is asking in the market is, of course, how long will you stay, the S&P stay at the 0% level, which, by the way, you've never been at. Is this really just a precursor? Is this really just a step to go back into negative territory?
Well, I cannot do a forecast on when we will move interest rates again. We will come together in September again and then take a decision on monetary policy. But what I can say is that going negative, we would not take this decision lightly, because negative interest rates, they come with challenges and also with side effects for a lot of actors in the economy. So we are well aware of all these side effects and challenges. So we would not take this decision lightly, and the hurdle to go negative is certainly higher than just like a lower interest rate in the positive territory.
Can you just elaborate on that? Because you said in the past, no one loves negative interest rates. The S&P does not love negative interest rates. What side effects are you specifically worried about? Is it potential asset price bubbles? Is it the pressure on banks? What is it?
Oh, there are several side effects. You just mentioned two. One is certainly in the real estate market. This is increasing prices at the margin if interest rates are lower, and this can lead to a situation where the market becomes even more vulnerable than it is already right now. Another factor is the profitability of banks. You also just mentioned this. The profitability of banks is not per se a goal of the Swiss National Bank, but the profitability of banks is, of course, the first line of defense for financial stability for banks, and therefore it matters.
But are you thinking that the Swiss banking sector right now is in a good position to deal with that pressure if it does come?
The Swiss banking sector is certainly in a good position. We just published our financial stability report today, so we have sufficient capital and also sufficient liquidity in the banking system overall. So lowering interest rates is not something that would put financial stability into danger at the moment.
Mr. Schlegel, talk to me about the main risks facing the Swiss economy at this point. Obviously, the strength of the Swiss franc is a major concern to exporters, has been for a long time. What about tariffs and then a potential longer-term increase in the price of oil?
So for the Swiss economy at the moment, the data is really hard to interpret because we have these different effects with the tariffs that some exporters exported earlier this year than they usually do. This makes the data really difficult to interpret. What we think is that the growth will come down in the rest of the year in Switzerland. And the risks are, of course, this high uncertainty from the trade situation globally, but there are also some geopolitical risks.
Mr. Schlegel, finally, I have to ask you about currency interventions. This is a tool that the S&B, of course, has resorted to heavily in the past, but it's become a little bit quieter on that front. And I'm curious as to why that is. Is it because it's simply not as effective as the lowering of interest rates, the interest rate channel, or is it simply because you do not want to draw the ire of the Trump administration?
Oh, we increasingly repeated in the last couple of quarters that if necessary, we will intervene in the FX market or be active in the FX market. And this is one of the tools that we have at hand. It's also important to say that Switzerland is not a currency manipulator. When we intervened in the past in the FX market, it was to achieve our goal, which is price stability in the medium term.